It's a weird problem to have, right? You are actually too good at saving for retirement. Today, we're going to break down exactly what happens when you accidentally contribute too much to a Roth IRA. And more importantly, we'll walk through the step-by-step process to fix it so you don't have to lose your cool or your hard-earned savings. So, let's say you've had an amazing year, maybe a promotion, a surprise bonus, or your side hustle just took off. That's fantastic. But that good news can sometimes create a hidden tax headache if it suddenly pushes your income over the Roth IRA limit. Don't worry though, you are definitely not alone in this, and we're going to go through the exact steps to make it all right. Okay, so this right here is the tripwire. The IRS uses this thing called Modified Adjusted Gross Income, or MAGI. It's basically your total income, but with a few specific deductions added back in. Now, for 2025, if you're single and your MAGI goes over $165,000, you can't contribute to a Roth at all. For married couples filing jointly, that number is $246,000. That range you see on the screen, that's the phase-out zone where your contribution limit starts to shrink. This is precisely where so many diligent savers get caught completely off guard. All right, here's our game plan. First, we'll look at how this mistake even happens. Then, we'll get into the nitty-gritty of that nagging penalty we're all trying to avoid. From there, we'll cover your best options for fixing it, both before and after the tax deadline. And finally, we'll dive into the specifics of actually filing Form 5329 to get you all squared away with the IRS. First up, let's talk about the overcontribution itself. This isn't about someone trying to cheat the system, not at all. It's really about having the best intentions and just running smack into some very specific and kind of complex rules. And trust me, it is so easy to do. A mid-year raise you didn't see coming, or even a change in your filing status, like getting married, can suddenly make you ineligible after you've already put money in. You might max out your contribution in January, feeling great about it, only to find out in December that you earned too much. The key thing to remember is this is just a simple mistake, not some catastrophic failure in your financial plan. And this brings us to the villain of our story, that pesky 6% penalty. Officially, it's called an excise tax under Internal Revenue Code Section 4973. This is the thing we need to neutralize. Now, it's really important to get what an excise tax even is in this case. It's not a tax on what you earned. It's a penalty tax for the simple existence of that extra money sitting in your account on December 31st. The IRS is basically saying, hey, that money shouldn't be here, and they're going to charge you 6% for every single year it stays there. And here's the real kicker. This isn't a one-and-done penalty. Oh no. If you have a $7,000 excess contribution, you'll owe a $420 penalty this year. If you don't fix it, you'll owe another $420 next year, and then again the year after that, all on that same original mistake. It just keeps stacking up, eating away at your savings. To really understand why this penalty is so nasty, let's compare it to others you might have heard about. You've got the 10% tax on early withdrawals, or the penalty for missing a required minimum distribution. Sometimes those can be waived if you have a reasonable cause. But this 6% excess tax, it's what's called a strict liability penalty. There's no waiver for an honest mistake. If the money's there when it shouldn't be, the tax is owed. End of story. Okay, enough about the problem. Let's get to the solutions. And believe me, your best, cleanest solutions are all available if you catch this mistake before the tax filing deadline. And that includes extensions, which usually pushes it to October 15th. You have two really great paths here. First, you can just withdraw the excess contribution and any money that it earned while it was sitting in the account. The second option, which is awesome if you still want to save for retirement, is to recharacterize it. That's just a fancy word for telling your brokerage to treat it like you contributed to a traditional IRA from the very beginning. Simple as that. Now, if you do choose to withdraw, you can't just take out the exact amount you overcontributed. Nope, you also have to take out what the IRS calls net income attributable, or NIA for short. This is honestly the trickiest part of a timely fix. It's the specific gain or loss that your extra money generated. Okay, deep breath. This is the official IRS formula. And yeah, it looks pretty intimidating. I get it. But don't worry about memorizing this. Your brokerage can often calculate it for you. What's really important is just understanding the concept. It's basically figuring out how your entire IRA performed while the excess cash was in there, and then applying that same performance rate to your specific overcontribution. Let's just simplify that formula. Think of it like this. Step 1, you find out what your account was worth right before the extra money went in and right before you plan to take it out. Step 2, you figure out the total growth or loss of the whole account during that time. And step 3, you just apply that overall percentage change to the specific amount you overcontributed. That's it. Let's make this real. Let's say Jim overcontributed by $1,000. During that time, the market did pretty well, and his calculated NIA was a positive $46.30. So to fix the error, he has to withdraw the original $1,000 plus that $46.30 in earnings. A total of $1,046.30 comes out.
But, and this is a really key point, what if the market went down? If Jim's account lost value, the NIA would be negative. Let's say it was negative $101.85. In this case, he only has to withdraw $898.15. So the formula actually accounts for your investment losses too, which, makes perfect sense.
Okay, but what if you missed the tax deadline? First off, don't panic. It is not too late. You can absolutely still fix the problem, but it is going to involve paying that 6% penalty for at least 1 year. At this point, you have 2 main strategies. The first is called an untimely withdrawal. You'll pay the 6% tax for every year the excess was just sitting there, and then you withdraw only the principal amount. The earnings, if there are any, actually get to stay. The second strategy is called absorption. Here, you pay the penalty every year until you get to a future year where you are eligible to contribute, and then you simply contribute less than the max, letting that old excess amount absorb the unused space. Now, regardless of how you decide to fix it, you have to report it to the IRS. And for a late correction, this is not a one-and-done filing. It's more like a multi-year conversation with the IRS, and you're using Form 5329 to do the talking. Check out this timeline. Let's say you made the mistake back in 2023. In 2024, when you file your taxes, you'd file a 2023 Form 5329 and pay that first 6% penalty. Now, if you withdraw the money sometime in 2025, you still have to file a 2024 form showing the excess was there all year. And yep, you pay the penalty again. Finally, in 2026, you file a 2025 form showing you finally removed the excess and the penalty finally stops. It's a whole process, but it's the right one. So when you actually sit down to fill out the form, it's all about knowing your lines. For Roth IRAs, everything we're talking about happens in Part 4. Line 23 is where you report a brand new excess. In the following years, that amount carries over to line 18. And when you finally take the money out, you report that correction on line 20. Okay, let's distill all of this down into a clear, simple action plan. 1. Keep an eye on your income during the year. 2. If you do overcontribute, try your best to fix it before the tax deadline to avoid penalties altogether. 3. For a timely fix, remember you have to remove the net income attributable, that NIA. 4. You absolutely must file Form 5329 to tell the IRS what happened and how you fixed it. And 5, this stuff can get complicated, so please never hesitate to talk to a qualified tax professional. And that really brings us to the end. This isn't just about forms and penalties, It's about protecting the integrity and the future of your retirement plan. So the question I'll leave you with is this. What's one simple step you can take today, like right now, to just verify your income and contributions and make sure everything is on track for a completely surprise-free retirement?